Imagine waking up to find your life savings cut in half overnight, while a handful of powerful players collect the profits and disappear into the dark. It sounds like a thriller, but in crypto, this scenario is closer to reality than you think. Behind the price charts and Twitter posts, large holders, including institutional investors and, yes, big banks, can move markets with transactions that look ordinary on the surface. They hoard, they time trades, and they sometimes use stealth tactics that make prices swing in their favor. The Federal Reserve found that large Ethereum holders, often called whales, tend to increase their holdings right before price surges, while small retail holders often sell out before the large gains. That means returns often flow to the big holders more than to everyday people. This is not accidental market noise, it is structural, and it raises the question, who really controls crypto prices, and how much of the market is being quietly steered for profit? If you own crypto, this video will show you what those moves look like, how they are done, and how to spot the signs before you lose money. What is a whale and why should you care? Start with the basics. A whale is any single wallet or entity holding a very large proportion of a token supply. In Ethereum, for example, whale wallets hold a substantial slice of the total supply. As of late 2023, whales owning millions in ETH controlled roughly 1/3 of ETH's supply, giving them real market power. When a whale sits on a mountain of coins, they reduce available supply, creating scarcity. When they move, markets can wobble. The Fed paper shows large holders change behavior differently than small holders, often increasing holdings before price upticks, which suggests either superior timing, stronger influence, or both. In plain terms, if someone can buy or sell amounts that equal a meaningful percentage of daily trading volume, they can move prices, trigger stop losses, and create panic or euphoria. That is why whales matter, and why their moves become read by other traders, algorithmic funds, and sometimes the exchanges themselves. The toolbox: 8 common whale tactics. Whales have a toolkit of strategy. Industry explainers list the common playbook, and many tactics show up again and again. Here are the main ones to know, with short edits you can use to dramatize each. Spoofing: placing fake orders to create a false sense of supply or demand, then canceling them. This tricks other traders into reacting. Wash trading: trading with yourself across accounts to fake volume, make an asset look hot, and lure buyers. Bear raids: coordinated selling or short selling to force a price drop and trigger liquidations. Cointelegraph documents how whales can weaponize short positions to snowball a crash. Pump and dump: driving a low-cap token to new highs via coordinated buys, then dumping to profit. This is ancient, but still effective on small coins. Spoofy-type manipulation: a nickname referencing spoofing plus persistent manipulation by a shadowy trader, as explained by market analysts. Order book layering: stacking orders at multiple price levels to manipulate perceived depth. Flash sales timed to liquidate margin traders, amplifying price drops. Exchange-level collusion and fake volumes, where some exchanges either look the other way or actively create conditions for manipulative behavior, noted in several industry reviews. How big banks fit in quietly now. Here is the uncomfortable part. Large banks and institutional desks, either directly or via trading arms and custodial partners, can act like whales. They have capital, custody relationships, and access to over-the-counter liquidity that can move markets without showing up in public order books right away. Institutional traders can place block trades, use dark pools, or route through counterparties to hide intent. On public chains, this can look like a large wallet moving funds to exchanges just before massive sell orders hit, then moving the proceeds off exchange. The Fed paper does not accuse specific banks, but it shows that large, sophisticated holders consistently secure returns that smaller holders do not. That pattern is consistent with institutional timing and market power. If some big players have off-chain advantages, like access to large OTC desks or early information, they can effectively influence price paths. In short, the machinery of traditional finance can leak into crypto, and when institutions act, markets often move. Real case studies you can put on a timeline. Let us walk a timeline with concrete examples, so this feels less theoretical. USDT in the 2017 run, researchers found spikes in stablecoin issuance tied to Bitcoin inflows during the 2017 surge. Studies suggested those stablecoins were used to inflate demand. This is an example of off-book activity changing price dynamics. Pump and dump Telegram groups. Academic work shows thousands of coordinated pumps in 2018 and beyond, producing artificial volume and short-term spikes. This shows how organized groups can target small coins with devastating results for late retail buyers. Bear raids and targeted shorts. Cointelegraph and market analysts have documented episodes where concentrated shorting and aggressive sell pressure led to cascading liquidation. Whales can time these to generate outsized returns from forced selling. Each example has a common pattern. Whales or organized groups create a perception of momentum or panic. Retail traders react emotionally or automatically, and the manipulators exit with profits. The Fed research adds evidence that these dynamics are not just small coin noise. They appear even in major tokens like Ethereum, where whale behavior correlates with future returns. That makes the whole market structure worth rethinking. The data you need to know explained plainly. You asked for heavy data. So here is the digestible version. The Philadelphia Fed paper used transaction-level data on Ethereum to compare whale activity and price outcomes. Their high-level findings are: large holders increase holdings prior to price increases. Small holders often sell before those increases, and volatility in returns is more driven by small retail traders than by whales. Put differently, the whales on average end up on the winning side of many price moves, while retail investors are left holding losses. The paper also notes that whales account for a substantial share of ETH supply, which magnifies their impact on liquidity and price. For a trader, the implication is sharp. If an address that holds a material share of supply begins to move, that single sequence of transactions can alter price paths, trigger automated stop losses, and cascade. That is not gossip. It is an empirical pattern identified by central bank research. How manipulation shows up in real time and how to spot it. Here are practical red flags you can look for in real time. Sudden huge orders that vanish. Orders appear in the book, then are canceled en masse. Classic spoofing behavior. If you see large orders at key levels that never fill, be cautious. Volume spikes without news. If volume explodes but there is no news, look at trade sizes and exchange concentration. Wash trading can inflate perceived demand. Coordinated social pushes, sudden hype on Telegram or Discord with synchronized buys often precedes pump and dump action. Academic studies have tracked this pattern. Unusual on-chain transfers to exchanges. Big wallet transfers toward exchanges followed by rapid sell pressure often mean large sellers are lining up. Monitor major wallet movements, what regulators and exchanges are doing, and why it is not enough. Regulators and reputable exchanges do act, but the ecosystem is complex. Some regulated venues pass manipulation checks, while unregulated exchanges fail them in tests. Researchers found that unregulated venues often show signs of trade size clustering and other red flags that could indicate market abuse. Some exchanges have improved surveillance and delisted suspicious tokens, and on-chain analytics firms flag wash trading. But enforcement is slow, cross-border, and often reactive. In addition, manipulation techniques migrate to places where oversight is weaker, and OTC routes can hide large flows. The result is a cat-and-mouse game. Regulators can help, but until there is consistent global enforcement and exchange transparency, whales and sophisticated players will find ways to profit. Here is the bottom line. Crypto is exciting, but it is not a fair fight. The market structure favors large, sophisticated holders in ways that often leave ordinary traders behind. The Federal Reserve analysis shows that whales systematically stand to gain more from price moves than small holders. That does not mean every whale is cheating, but it does mean when large players move, the rest of the market needs to watch closely and act carefully. If you trade, use risk limits, watch major wallet flows, and do not chase sudden pumps. If you invest long-term, focus on projects with real adoption and transparent markets. Please, If you found this video helpful, smash the like button, subscribe, and ring the bell for more deep dives into how money moves behind the scenes.